For months, maybe even years, you've been told to get ready for another stock market wipeout. Every time you turn on the financial news, you see the flashing warning signs, you hear the pundits predicting doom, and everyone is just waiting for a repeat of 2008. They're telling you to prepare for your 401k to get chopped in half, for the housing market to go into a deep freeze, for all the dominoes to fall just like they did before. But what if they're all looking in the wrong direction? What if the biggest financial collapse of our lifetime isn't in the stock market at all? What if the crash has already started, but it's happening in a way that almost nobody understands? My name is Timothy George. I'm an investor and a partner at a leading Bitcoin venture capital fund. I've been through multiple market cycles, I've seen the bubbles inflate, and I've watched them burst. And I'm here to tell you that the story you're being sold about the next crash is dangerously incomplete. I believe the real bubble, the one that poses a permanent threat to your savings, your retirement, and your family's future, isn't in tech stocks or real estate. It's in the one asset that everyone, from your grandparents to the most sophisticated institutions, believes is the ultimate safe haven. The bubble is in government bonds and, by extension, the US dollar itself. And when this bubble finally implodes, there won't be a reset button. This isn't some temporary downturn where you can just buy the dip. This is a permanent repricing of money itself, and those who don't see it coming will have their wealth erased. The crash is here. It's happening right now. But it's not the crash you've been trained to expect. It's not a deflationary spiral where the prices of things collapse. It's an inflationary one, where the value of the money you use to buy those things collapses. The S&P 500 is trading near all-time highs, yet for millions of people, a comfortable life feels more out of reach than ever. How is that possible? It's because the yardstick we use to measure wealth, the dollar, is breaking. In the next few minutes, I'm going to show you the undeniable evidence that the US government bond market is, in my opinion, the largest and most dangerous bubble in financial history. I'll explain why this makes the dollar itself fragile and why the fallout will be far worse than 2008. And most importantly, I'll lay out a clear framework for how you can not only protect yourself, but potentially build generational wealth during this unprecedented financial shift. To really get the magnitude of the threat we're facing, we have to understand why it's not a repeat of 2008. Everyone remembers the global financial crisis. It was a classic deflationary crash. A massive credit bubble centered on the US housing market just popped. Subprime mortgages, which were built on a foundation of lies, started to default. The complex bets tied to them, like collateralized debt obligations, CDOs, became toxic almost overnight. Institutions like Lehman Brothers, loaded up with this toxic debt, just imploded. Credit markets froze solid. The stock market cratered, with the S&P 500 falling over 50%. Home prices plunged 30%, 40%, even 50% in some places. It was an absolute bloodbath. If you held stocks, real estate, or corporate debt, you lost a fortune. But what was the safe asset back in 2008? What was the one thing you could hold to protect your wealth? It was cash, the US dollar, and by extension, US Treasury bonds. During that panic, a tidal wave of capital fled from risky assets and flooded into the safety of dollars and government debt. The dollar actually got stronger. Yields on treasury bonds fell as demand for them went through the roof. In a world of chaos, the US dollar was the only port in the storm. The government and the Federal Reserve were able to step in, print money, bail out the banks, and eventually restart the economy. It was painful, no question, but there was a reset. Assets got cheap again. For those who had cash, it was the buying opportunity of a lifetime. You could scoop up stocks at a massive discount. You could buy real estate for pennies on the dollar. The system shuddered, but its foundation, the dollar, held firm. This is the crash that is seared into the collective memory of every investor. And it is the exact wrong model for what is happening today. What we are living through now is not a deflationary crash. It is an inflationary one. This isn't a crash down where the nominal prices of assets fall. It is a crash up where the prices of assets measured in dollars skyrocket, not because they are becoming more valuable in a healthy way, but because the dollar itself is becoming worth less. Think about it like this. Imagine you're measuring a table with a ruler. If the table seems to be getting longer every single day, you might think the table is growing. But what if the problem is that your ruler, your unit of measurement, is actually shrinking? The table isn't changing. Your perception of its size is, because your yardstick is broken. The dollar is our financial ruler, and it is shrinking. The crash isn't happening to stocks or houses. It's happening to the dollar. The media tells you to watch the stock market for signs of collapse. But as of the third quarter of 2025, the S&P 500 has gained nearly 15% year to date. This doesn't look like a crash, does it? But this performance is deceptive. It's heavily concentrated in a handful of mega cap technology companies, the so-called Magnificent Seven. In the first three quarters of 2025, these few companies accounted for over 40% of the index's total return. This isn't a sign of a broad, healthy market. It's a sign of a flight to quality. Investors aren't buying the whole market. They're piling into a few select cash-rich companies that they believe can weather the storm better than the dollar itself. These companies are acting as lifeboats in a sea of currency devaluation. In 2008, the problem was with the assets built on top of the system, the houses, the stocks, the credit derivatives. The solution was to flee to the foundation, the dollar and government bonds. Today, the problem is the foundation. The bubble isn't in a specific asset class. The bubble is money itself. So, where do you run for safety when the very definition of safety is the source of the risk? That is the terrifying question that separates our current crisis from everything that has come before. So, why do I believe the dollar and government bonds are a bubble? To get it, you have to look at the single most important number in the global economy, the US national debt. As of October 2025, the US national debt has surged past an almost incomprehensible figure, $37.8 trillion. That's a number so large it just loses all meaning. To put it in perspective, the debt has shot up by over $2.17 trillion in the last year alone. That means the government has been borrowing at a rate of nearly $6 billion every single day. Per household, the national debt now stands at over $286,000. But the total number, as shocking as it is, isn't even the scariest part. The truly alarming figure is the debt relative to our country's entire economic output, or GDP. As of late 2025, the US debt to GDP ratio is around 124%. This means we owe significantly more than our entire economy produces in a full year. Projections from the Congressional Budget Office are even more dire, forecasting this ratio could climb to 156% by the year 2055 if we stay on this path. This mountain of debt is represented by US Treasury bonds. For decades, these bonds were seen as the bedrock of the financial system, the risk-free asset. Why? Because they were backed by the full faith and credit of the United States government, which had the power to tax the world's largest economy to pay its bills. But what happens when the debt grows so large that it can never realistically be paid back through taxation? What happens when the interest payments alone start to consume the entire federal budget? We're at that point now. For fiscal year 2025, the interest payments on the national debt are projected to exceed $1 trillion and could approach $1.2 trillion. That's a staggering sum of taxpayer money being spent not on roads, not on schools, not on healthcare, but just to service the interest on past borrowing. This creates a terrifying feedback loop known as a sovereign debt spiral. The government has to borrow more and more money just to pay the interest on the money it already borrowed. It's the definition of an unsustainable path. A household that does this goes bankrupt. A company that does this goes bankrupt. A country that does this has only one escape hatch, an option you and I don't have. They can print the money they need. And that brings us to the Federal Reserve. The Fed's official job is to maintain stable prices and maximize employment. But over the last 2 decades, it has picked up an unofficial third mandate to enable the US government's massive deficit spending. During the pandemic, the Fed went on an unprecedented money printing spree, known as quantitative easing, QE, buying up government bonds and expanding its balance sheet to nearly $9 trillion. While the Fed has since tried to reduce its holdings through quantitative tightening, QT, its balance sheet still stands at a massive $6.5 trillion as of October 2025. And now there are already hints that this tightening is coming to an end. Federal Reserve Chair Jerome Powell recently suggested that the central bank may soon stop the runoff as tightening liquidity starts to strain financial markets. Why would they stop? Because the system can't handle it. The US Treasury needs to issue trillions in new debt every year, and there simply aren't enough natural buyers in the world for all of it. Foreign buyers like China and Japan have been reducing their holdings, so the Fed, either directly or indirectly, becomes the buyer of last resort. The government spends money it doesn't have, the Treasury issues debt to cover it, and the Fed creates new money out of thin air to buy that debt. This is the textbook definition of monetizing the debt. It's the modern version of a king clipping the edges off gold coins to debase the currency. Every new dollar created to finance the deficit devalues every other dollar in existence. The dollars in your bank account, in your paycheck, and in your retirement fund. This is why the bond market is a bubble. Its value is based on the idea that you'll be paid back in the future with money that has similar purchasing power. But the very mechanism being used to prop up the bond market, endless money creation, ensures that the dollars you get back will be worth dramatically less than the dollars you invested. The safety of treasury bonds is an illusion. You're guaranteed to get your dollars back, sure, but you're not guaranteed that those dollars will buy you anything. When the world's risk-free asset is, in reality, a guaranteed loser in purchasing power, the entire financial system is built on a lie. That is the bubble, and it's the biggest one in history. When smart money smells smoke, it doesn't wait around to see the fire. It quietly heads for the exits. And right now, we are witnessing one of the greatest capital migrations in history. Investors, corporations, and even central banks are desperately trying to get out of cash and bonds and into anything that cannot be printed into oblivion. This is the proof that the dollar collapse isn't some future event. It's a process that's already happening. Let's just look at where the money is going. First, look at gold. For thousands of years, gold has been humanity's ultimate store of value. It's the original hard money. You can't print it. Its supply is limited by the laws of physics and the sheer difficulty of mining. In an era of out of control currency debasement, gold is doing what it has always done, preserving wealth, and its price is screaming a warning. As of October 2025, the price of gold has been surging, smashing through previous records and trading at levels above $1,400 and even touching $4,200 an ounce. This isn't just a small move, it's a parabolic ascent that signals a profound loss of faith in government issued money. Central banks worldwide have been buying gold at a historic pace, diversifying their reserves away from the US dollar. They see the writing on the wall. Second, and maybe even more telling, is the rise of Bitcoin. Created in the ashes of the 2008 crisis, Bitcoin was designed as a direct answer to the failures of central banking. It is the world's first and only truly scarce digital asset. Its supply is permanently capped by its code at 21 million coins. No central bank can inflate it. No government can seize it without your keys. It is a decentralized, non-sovereign store of value. And the market has clearly taken notice. Recent data from October 2025 shows Bitcoin trading at prices around $111,000 to $112,000, with some analysts predicting it could move toward $126,000. While it experiences volatility, the overall trend is undeniable. Capital is pouring into Bitcoin as a hedge against fiat currency collapse. It's acting like an escape valve for a financial system under immense pressure. In my view, it's the fastest horse in this race for scarcity. Billionaires, hedge funds, and public companies are now holding Bitcoin on their balance sheets, calling it a superior alternative to cash. They get it. In a world where money is printed without limit, mathematical scarcity is the ultimate safe haven. Third, look at the stock market itself. As I said before, the headline gains in the S&P 500 are driven by a tiny handful of mega cap tech stocks. Why are companies like Apple, Microsoft, and Amazon doing so well? I'd argue it's not because they're in a speculative bubble, but because they have become a store of value in their own right. These are global giants with fortress-like balance sheets, immense cash flows, and the power to set prices. They own the digital infrastructure of our world. For many investors, holding shares in these companies feels safer than holding depreciating dollars in a bank account. They aren't just stocks anymore, they're behaving like quasi-monetary assets in a system that's breaking down. Finally, just look at hard assets like prime real estate, fine art, and collectibles. Prices for trophy properties in major world cities, rare watches, and classic cars have all exploded. This isn't just rich people spending for fun. It's a desperate search for things that are real, tangible, and scarce. When you no longer trust money, you trade it for something you can touch, something that has an enduring value that can't be wiped out by a central banker hitting print. What you're seeing across all these different asset classes is not a series of disconnected bubbles. It is one single unified movement, a mass exodus from the dollar and other government currencies. What looks like speculation is actually an act of preservation. The crash up is in full swing. The prices of scarce assets are rising to reflect the falling value of the money used to price them. The market is screaming its verdict on the future of the dollar. The only question is, are you listening? So what does this crash up, this collapse in the value of the dollar, actually mean for you, your family, your retirement? It's a threat that's far more sneaky than a stock market crash because it attacks the very foundation of your financial life. When the stock market crashes, it's brutal, but it's obvious. You see the red on the screen, you feel the panic. But with a currency collapse, the theft is silent. It's a slow, creeping erosion of your purchasing power that happens every single day. First, think about your savings. Any money you have in a savings account, a checking account, or a CD is a melting ice cube. The interest you earn is a joke compared to the real rate your money is losing value. Every day you hold cash, you are getting poorer. The number in your bank account might stay the same, but what it can buy in the real world is constantly shrinking. That car you wanted is now 10% more expensive. The down payment for the house you were saving for now seems impossibly far away. You're doing everything right, saving diligently, living below your means, but you feel like you're running on a treadmill, working harder just to stay in the same place. This is the direct result of a devaluing currency. Now, think about your retirement. This is where the danger becomes truly catastrophic. For generations, the standard advice was to build a balanced portfolio of stocks and bonds. As you get older, you're told to shift more money into the safety of bonds to protect what you've saved. But as we've established, bonds are now the epicenter of the risk. They are a promise to be paid back in a currency that is being systematically destroyed. If your 401k or pension fund is heavily allocated to government bonds, you are not protected. You are sitting on a ticking time bomb. You might reach retirement age, look at your account statement, and see a big number, $1 million, maybe more. You might think you've made it. But when you go to live on that money, you'll find that your $1 million buys what $300,000 used to. Your safe retirement plan has led you directly into a form of poverty. This also has huge implications for programs like Social Security. The Social Security Trust Fund is already on an unsustainable path. Projections from 2025 indicate the fund's reserves will be depleted as early as 2032 or 2033. At that point, unless Congress makes major changes, benefits would have to be cut by around 23%. This isn't some far off problem. It's a crisis that will hit within the next decade. The promises made to generations of workers are built on a financial foundation that is crumbling. The crash up creates a society of permanent renters. When asset prices rise exponentially, not because the economy is booming, but because the currency is failing, it becomes impossible for young people and the middle class to ever get ahead. Housing becomes permanently unaffordable. The dream of owning a home and building equity gets replaced by a lifetime of paying ever increasing rent to a landlord class that already owns the assets. This isn't a wild prediction, it's a historical certainty. Just look at what happened in the Weimar Republic in the 1920s. People's life savings held in the German mark were wiped out in a matter of months by hyperinflation. A wheelbarrow full of cash couldn't buy a loaf of bread. The prudent savers were destroyed, while those who held real assets, land, factories, gold, survived and even thrived. Now, I'm not predicting we'll be using wheelbarrows for cash tomorrow, but the underlying dynamic is exactly the same. The government is financing its obligations by creating currency, and the end result of that policy is always the same: the destruction of savings and the impoverishment of the middle class. This is the crash that is worse than 2008. It doesn't just reset asset prices, it destroys the very idea of money and savings for an entire generation. At this point, you might be feeling pretty helpless. If the whole financial system is the bubble, what can you possibly do? It's a scary situation, but I want to be crystal clear. This is not a time for fear. It is a time for understanding and for taking action. This financial shift, as dangerous as it is for the unprepared, is also one of the single greatest opportunities to build wealth in modern history. The transfer of wealth from people holding depreciating currency to those holding scarce assets will be absolutely staggering. Your goal shouldn't be to just survive this. Your goal should be to position yourself on the right side of this massive transfer. So, how do you do it? The strategy is simple, but it requires a radical shift in how you think about money. You have to move your wealth from assets that can be created in unlimited quantities to assets that are provably scarce. You need to get out of currency and get into real things. Here is a blueprint for building your own financial arc. First is your foundation, hard money. This means gold. For 5,000 years, gold has been the ultimate monetary anchor. It has outlasted every government, every empire, and every fiat currency. Owning physical gold isn't an investment in the traditional sense, it's an insurance policy against systemic collapse. It's your bedrock, the part of your portfolio that will hold its value through any storm. Second is the engine of growth for our time, Bitcoin. Bitcoin represents the monetization of a brand new, pristine asset. It's the only asset in the world with a perfectly fixed supply. Its scarcity isn't just a promise, it's enforced by mathematics and a global decentralized network that has never been hacked. While gold is the monetary anchor of the past, Bitcoin is quickly becoming the monetary anchor of the future. It's borderless, easy to transfer, and can't be censored. In my professional opinion, even a small allocation to Bitcoin offers an incredible asymmetric opportunity on the future of money. Its potential upside as the world continues to wake up to the problem of currency debasement is immense. Third, you need to own productive assets. This means investing in high quality businesses that have real cash flow and pricing power. In an inflationary world, a business that can raise its prices to keep up with the falling value of the currency is priceless. Think of companies that provide essential goods and services, that have powerful brands, and that aren't drowning in debt. These businesses act like a sponge, soaking up the newly printed money and converting it into real earnings. Owning a piece of a great business is a powerful way to protect yourself. Fourth, consider hard assets like prime real estate. I'm not talking about speculating on condos in an overbuilt city. I'm talking about well located, desirable property. Like gold, the supply of great land in great locations is finite. It is a tangible asset that provides utility and tends to hold its value against inflation over the long run. What do all these things, gold, Bitcoin, great businesses, and prime real estate, have in common? They are all scarce. Their supply cannot be magically increased by a government decree or a central bank's printing press. They represent real value in a world that is being flooded with fake money. Moving your wealth from dollars into this basket of scarce assets is the single most important financial decision you can make today. It requires you to unlearn everything you've been taught about safe investing. It requires you to accept that the rules of the game have changed for good. The dollar is no longer a store of value. It is a liability. Your savings account is not a safe harbor. It is a leaky boat. The choice is yours. You can stay on the sinking ship clinging to the false security of government money and watch your wealth evaporate. Or you can board the ark and sail towards a future where your wealth is anchored to something real, something scarce, and something sovereign. The crisis isn't coming, it is here. The crash up is accelerating, and the window to protect yourself is closing. The silent theft of your wealth is happening every single day, and you can't afford to ignore it. You have to move from currency to assets. You have to choose scarcity over infinite supply. This is a complex topic, and we've only scratched the surface. Understanding what makes an asset a true store of value is critical to navigating the years ahead. If you want to go deeper into how to evaluate these scarce assets and build a strong portfolio for this new financial era, make sure you subscribe to this channel and hit that notification bell. In our next videos, we'll break down the specific characteristics of gold, Bitcoin, and other hard assets so you can make informed decisions with confidence. Thank you for watching. The path forward is clear, but it takes courage to walk it. The time to act is now.